What was the first paper that you published in your career?
I published papers both on IPOs, which was my dissertation, but I was also working on putting data together, of course, the stocks, bonds, bills, and inflation. So I published 2 papers on stocks, bonds, bills, and inflation, one on the past and one on the future, and future making forecast out to the year 2000. So those all kind of took place at approximately the same time. So I published my 2 papers on IPOs and 2 papers on stocks, bonds, bills, and inflation. So they were all coming out fast and furious at first, and so it was just, I actually, of course, I stopped working on IPOs pretty much at that time too, but because what happened was the IPO market, well, one of my papers was called Hot Issue Markets. This was Jeff Jaffe at the time, Hot Issue Markets. And by the time it got published, you know, there's a publication lag. Well, by the time it got published, there were no more hot issue markets. The markets were cold, and they weren't having any new issues, and so it was not really a thing to study anymore. So I stopped studying that. And so but I definitely continued on with the stocks, bonds, bills, and inflation.
You say stocks, bonds, bills, and inflation, so those are the basics of the U.S. capital markets. Those 2 papers I wanted to ask you a little bit more about. The first one was about looking at the historical performance of the long-term performance of the stock markets, and is the basis for what people now call the equity risk premium. And how did you get the idea to delve into the history of it, and how did you get the data?
Being at the University of Chicago, it was a great place because this is where the Center for Research and Security Prices, we call it CRISP, was, and they had Larry Fisher and James Lorry had put together data on the stock markets, and also, by the way, Larry Fisher had put data together on the bond markets. I got a job managing the university bond portfolios while I was getting my PhD. I had to give it up when I became an assistant professor there. But while I was getting the PhD, I had that job managing the bond portfolio. And while I was managing that bond portfolio, everybody asked me all the time, when are Fisher and Lorry going to update their stock market studies? Because they first had a study that went from 1926 to 1960, and then 1926 to, they brought it up to 1965, and then to 1968. But this was in the early 70s now, and when were they going to update it? And I would ask them when was the update, and they'd give me a date, and that date would pass, and I knew that we needed to have something more current because it wasn't getting updated at the same frequency. So I had a great desire. Everybody was asking me to basically put that data together. I put that data together, but at the same time I did that, I wanted to answer all these questions about these risk premiums, because that's the other thing everybody's wondering about. What was the magnitude of all these risk premiums that we have in the market? And so when you put in the bond data in there, and the bill data in there, and the inflation data in there, suddenly you get a real interest rate, you get a horizon or interest rate risk premium, you get when you put in corporates, you get a default risk premium, and of course when you compare stocks to bonds or bills, you get the equity risk premium. So it was like all this data really was there. It had to be collected, but it was all accessible at the University of Chicago, and it was answering the questions that really everybody was asking, and it was just amazingly exciting when it came out. Everybody wanted to hear about it.
So how do people use that data? When I say people, how do financial institutions and planners and so forth, how do they use that data now, and why is it ususeful?
Well, they use it so many different ways, really. Of course, you want to know what the long-term return of the stock market is. And I will say that what I'm really most known for, I suppose, is a chart, putting together that data into starting in 1926, investing $1 and letting it ride in the stock market.
One thing I wanted to do is ask you about the second paper, the forecasting paper, because you estimated an equity premium in 1975 or 76. How did that pan out over time?
When we made the forecast here, and it was Ibbotson and Singfield at the time, this forecast. Rex Singfield was my co-author on this. We projected out to the year 2000, and essentially we said that, and we made different kinds of forecasts, but one of them was on the Dow, and we said the Dow would hit 10,000 and approximately 2,000. And that got picked up by the press. And this was in 1975. So we had just been through the 73, 74 recession and the collapse of the stock markets. And suddenly some economist is saying something about what's going to happen over the next 25 years, and the Dow, which was say 800 or something like that, was going to grow to 10,000 by 2000. And it made the newspapers all over the place, of course, and so forth, because they needed somebody to say something optimistically. So it seemed to be a grandly optimistic forecast. It actually turned out, though, to be almost exactly right, I guess, because I went on, I think it was CNBC or something like that, and in 1999, when it did hit 10,000, of course, on that day. So it actually, of course, was approximately right.
What are the sources of return and value that you think about when you're not just doing your research, but also in your world of money management that you've entered into?
Well, first of all, I still certainly believe that there's going to be an equity risk premium. It's not going to go away. Of course, it isn't constant. It can get smaller or larger. And really, it gets back to my broader belief, I guess, which I've been working on for decades as well, is the supply and demand of capital markets. And some of it's empirical and some of it's theoretical. And essentially, and the demand side, if people are risk averse, then they're going to find equities less desirable than bonds. And the only way you're going to get people to buy equities instead of bonds is to actually have them expect to have higher returns. That's what the equity risk premium is about. It's really a payoff for something that a risk aversion for something that people don't like. But I've generalized this, you see. So it isn't just equity risk premiums. Of course, we don't like risk, but there's lots of things we don't like. And lots of things we like, you know. So we like liquidity. We don't like less liquidity. We like brands, you know. We like things that we are well recognized. We don't like the kind of things that we don't know much about. And so all these things end up being in the pricing of assets here. And some of them then, if they're more permanent and systematic, actually turn out to be the premiums that we talk about. And I guess one of the key things I'm really saying here is these premiums, a lot of academics think of always these premiums as risk premiums. They're not necessarily risk. They're just things we don't like. We don't like risk. That's one of the things we don't like. But there are a lot of other things we don't like. And some of them might be associated with risk. But some of them, like liquidity, you can force liquidity into a risk premium if you like. But liquidity isn't necessarily about risk. It's about transaction costs and hard to trade and things like that. It isn't necessarily risk. You can make a risk factor out of it if you like, but that doesn't catch the essence of what liquidity is all about. So, of course, written on liquidity as well. So all these things, essentially, though, it gets back to, I guess, my latest monograph that's just out now is called, with three other co-authors, it's called, though, Popularity, a Bridge Between Classical and Behavioral Finance. And it puts a lot of this together here because it encompasses now the premiums of the market and other behavioral aspects of the market, things that we like or don't like. And all of these things enter in the pricing and the mispricing of markets.
Maybe I could turn to the business side of your life, and you created a new firm, Ibbotson Associates, and I guess launched it in Chicago. And I wanted to know a little bit more about how that began, but also I'm curious how you managed this very successful firm throughout the time that you've lived in New Haven and the firm itself was still located in Chicago.
I kind of backed into becoming a professor. I hadn't actually planned to be a professor. Now I'm so happy I have been a professor, actually. It's been a wonderful, stimulating experience. But I hadn't planned on it. I planned on being a businessman, essentially, pretty much from the start. And my father was a businessman. He was in the trade business. He was heating and air conditioning. And so it was a small, successful business. And I imagined I probably would have gone into my father's business if I had been more mechanically inclined. I really felt pretty inept at all those things, and I really had to find another route, a little more abstract. The finance field is more abstract. But I found that if you want to understand really what's going on, you kind of look at it both from the inside and from the outside, I guess.
Tell me a little bit about what Ibbotson Associates did, and then perhaps evolution of the firm.
I did the stocks, bonds, bills, and inflation back in the late 70s or middle 70s. And the first thing that happened to me, it did become famous immediately. And I was an assistant professor. I barely had a secretarial help in any way. And I was getting all this mail from CEOs asking me all these questions and asking me, making requests and all that sort of thing. And I had no idea what to do with this. I was just a person, with no help. And that's why I set up the business originally just to help me process all the requests, really, and so forth. And I started doing consulting and so forth. So I found I had plenty of business to do, I guess, because just as basically as a consultant, and then ultimately to have this built into software so that we could sell things more off the shelf that wasn't just my own personal consulting all the time, because I was limited in how much I could do as a consultant as well, of course, even if I had staff. So Ibbotson Associates really started with stocks, bonds, bills, and inflation. Really, the big demand was there, and it basically we became a software data publishing, and we got a lot into asset allocation. And of course, I've done a lot of research then on asset allocation as well. Asset allocation, basically how you mix portfolios, especially for individuals, between stocks and bonds, of course, and other kinds of assets.
It's been wonderful to visit and learn more about your career, and enjoyed it.
One of the things I should have mentioned here, by the way, is I've done a fair number of articles with you. I really grateful to have you as one of my colleagues over all these years. And so this discussion and this interview is just, I guess, one more example of the great kind of engagement we can have here at Yale.